I've seen crypto change lives and ruin them right here in Australia. At Navextra, I've worked with thousands of investors and I've seen both sides of this market. Some people build life-changing wealth and others lose everything overnight. When FTX collapsed, I watched friends and clients get completely wiped out. They didn't even know what they owned or where their crypto was held. That moment made something really clear to me. Most people jump into crypto without a plan, no idea why they're buying, what they're buying, or how they'll even know if it's working. And that's what separates investors from gamblers. The truth is, most people think they're investing when they're actually gambling. If you're serious about crypto, by the end of this video, you'll know how to avoid the mistakes that quietly eat away at your returns. All right, the first thing I always ask people is simple. Why are you actually buying crypto? Most people don't have a real answer. They'll say, because it's going up, or my mate said it's the next big thing. That is not a reason, that is a reaction. And look, I get it, we've all been there. You see the price pumping, everyone's posting screenshots, and suddenly you've got FOMO. But if your reason to buy is someone else's excitement, you don't really have a plan, you're just borrowing someone else's conviction. So ask yourself, are you trying to build long-term wealth? Are you stacking Bitcoin for the next decade? Or are you chasing a quick 50% move because it feels exciting? There's nothing wrong with speculation as long as you're honest with yourself about what you're doing. Because your why dictates everything else. It decides what coins make sense for you, how much risk you can take, and how you'll react when the market drops 30% overnight, which it probably will. The people who last in crypto don't have perfect timing. They just have a clear reason to stay invested when everyone else is panicking. So before you buy anything, take a minute and figure out what your actual goal is. Is it wealth, freedom, curiosity, speculation? Write it down if you have to, because if you don't define it, the market will define it for you. And that's never in your favor. The next thing I ask people is, do you actually know what you're buying? And most people say, yeah, crypto, but crypto isn't one thing. It's a whole ecosystem. You've got Bitcoin, a decentralized network built to be sound money. You've got Ethereum, the backbone for apps, NFTs, and smart contracts. Then you've got a few thousand coins that were created mostly for hype and will probably disappear next year. So before you hit buy, ask yourself, do I understand what this project is? What problem is it solving? And why does the token even exist? Because there's a big difference between owning a protocol, something that creates real utility, and holding a project that's just hoping for attention. I'm looking at you, Fartcoin. You don't need to be a blockchain expert, but if you can't explain a token in one or two sentences, you probably don't understand it well enough to even own it. And here's the thing most people miss. In crypto, the story changes faster than the price. Projects pivot, founders disappear, communities move on, and if you're not keeping up with what you actually own, you're just flying blind. So don't just watch the price chart, read the white paper summary, find out who's behind the project, understand the use case, because when you understand the value, you can handle the volatility. All right, next, where are you actually investing? Because not all platforms are created equal. I've seen people lose entire portfolios, not because of bad trades, but because the exchange they were using just disappeared. We all remember FTX. Billions gone overnight. And it wasn't just traders on the other side of the world. A lot of Aussies got caught up in that too, including myself. I had funds on there. One day it was fine. The next day, completely gone. That experience hit hard and drove home a lesson I'll never forget. Where you buy your crypto matters just as much as what you buy. In Australia, make sure you're using an exchange that's AUSTRAC registered and actually complies with local regulations, because that means there's at least some oversight and someone to answer to if things go wrong. And here's where a lot of people get tripped up. There's where you buy and there's where you hold, and they are not the same thing. If all your coins are sitting on an exchange, you don't really own them. If you can log in and see your crypto, but you can't move it without the exchange's permission, it's their crypto, not yours. And if you don't hold your keys, you don't hold your coins. Now that doesn't mean everyone needs to rush out and buy a hardware wallet tomorrow. Self-custody has its risks too. You lose that device or your recovery phase, game over. So it's about balance. You've got to figure out your comfort level. How much control do you actually want? And how much responsibility are you willing to take? For some people, cold storage makes sense. For others, a regulated exchange with extra layers of protection is fine. There's no one size fits all answer, but pretending it doesn't matter, that's the mistake. Because in crypto, ignorance isn't bliss, it's expensive. All right, next. Timing. This one separates the tourists from the true investors. Are you stacking Bitcoin regularly or trying to time every move? because those two are completely different games. If you're dollar cost averaging into Bitcoin or Ethereum every week, you're playing the long game. You're focusing on accumulation and discipline. But if you're jumping in and out based on headlines and swings, that's not investing, that's reacting. Here's the thing, both approaches can work, but only if you know which game you're actually playing. Because when you mix those two approaches, that's when it all goes wrong. You buy like an investor, but you end up selling like a gambler. You tell yourself you're in it for the long term until the market drops 40% overnight. And that's why it's so important to decide ahead of time, when will you buy and when will you sell? Maybe a sell rule is a price target. Maybe it's a time horizon. Maybe it's when the project stops doing what you bought it for. Once you've set that rule, you end up taking so much emotion out of it, because when things get volatile, all you need to do is ask yourself one question: does it meet my sell criteria? That's how you turn reactions into responses. The best investors aren't the ones who time the top or bottom, they're the ones who keep their heads when everyone else loses theirs. Crypto moves fast, it's emotional, but discipline is what keeps you in the game long enough to win it. Alright, here's the part almost no one thinks about until it's too late. How will you actually track your crypto? Not the price, your performance. Most people think their exchange dashboard tells the full story, but it doesn't. It just shows what's sitting on that one platform. The moment you move coins to another wallet, stake something, earn a reward, or swap one token for another, that picture completely breaks. Then tax time rolls around and you're sitting there trying to rebuild 2 years of trades from random CSV files. I've seen people spend weeks trying to untangle it and still get it wrong. What gets measured gets managed. My man Peter Drucker. If you don't measure your results, you can't manage your performance. And you definitely can't improve it because you don't even know what it is. So treat record keeping like part of the investment. Track everything from day one. Your buys, sells, transfers, rewards, and fees. It's not just about the tax, it's about seeing what's actually working. Because crypto can make you feel like you're crushing it, right up until you realize you've made 200 trades and most of your gains went to fees, tax, and slippage. So tracking keeps you honest, it shows you the truth, the good, the bad, and the fixable. And yeah, that's a big reason why I built Navexa in the first place. To make that part simple, accurate, and automatic. Because nobody wants to spend their Sunday night wrestling a spreadsheet just to figure out if they're actually ahead. You can't control the market, but you can control your data. And that's where better investing starts. So before you buy any crypto, slow down for a second. Ask yourself the hard questions. Why are you investing? What are you buying? Where are you holding it? When will you buy and sell? And how will you track your results? Most people skip this stuff, and that's why most people lose money. But if you can answer those questions honestly, you're already ahead of 90% of the market. Because this game isn't about luck, it's about clarity. It's about knowing what you're actually doing, why you're doing it, and having the patience to let good decisions play out. Crypto rewards preparation and it punishes carelessness. So get clear, be deliberate, and invest with intent. If you found this helpful, give it a like and subscribe for more practical data-driven investing insights for both the traditional stock markets and crypto. Check out the next video.